We're going to be looking at order flow. We're going to be looking at various aspects of order flow right through this part of the process, and it's for some people it's going to be really basic because obviously you've maybe used order flow significantly in the past. For other people, it might be the first time you've ever came across order flow. So we've got to be aware of not being too highbrow at these types of things, and bring it back right back to the beginning again, so that we can start looking at order flow in a clean and you know, on something or another way. I don't know what word I was going to think of there, guys. It's obviously just left my brain completely. But you don't want to have an idea about order flow before you start order flow, because those ideas a lot of the time are going to be false. And you know, you want to make sure that you're clear about what we're looking at, why we're looking at it. And you know, and because of that, you want to be able to get into your order flow charts, which are these footprints that you can see on the chart. But this isn't the only way you can see order flow, of course. There's plenty of different ways to play order flow. You can look at order flow on a normal bar chart. You can take it down into 1 minute charts, and you'll get a lot of detail on those charts. As well as looking at this type of chart, which is the footprint chart that you can see on the screens, where it's got the bid and offer. You can take the bid and offer off the chart, and you can replace it with net deltas, for example. You can do all sorts of things with order flow. So what's the problem with it? Where are the problems? Why is it always giving you some issues? Why is it always looking at you know, why is order flow a difficult subject for people to really master? And the reason for that is something very, very simple that retail traders don't quite get when they first start trading, and that is in the vast majority of cases, and I'm talking about 99.9%, slow and steady wins the race. You've probably heard that expression before. Slow and steady wins a race. Order flow is never going to be about a one-win and then that's you're fantastic, you're brilliant, you're this, you're that. Slow and steady wins a race. In other words, you're going to pick up one win, followed by a second win, followed by a third win, followed by a fourth win. And through the process, you're going to start finding the right trades at the right prices. You're going to sometimes have scratches, you're going to have sometimes a couple of small stop outs, and then there's going to be other times you're going to catch the occasional big winner. But it's not the big winner that's going to define your trading. It's all those little scratch trades that you picked up 5 ticks and break even. And then all of a sudden you say, well, instead of making 5 ticks and break even, I was actually losing 5 ticks on each of those trades because I wasn't aggressive enough. I didn't see the signs that the order flow was perhaps changing. And as a result, I've had 5 trades losing 5 ticks instead of 5 trades, 5 ticks each, losing 25 ticks in total instead of 5 trades making 25 ticks, and then the occasional one trade that makes 25 ticks as well. And your book looks a bit like a scratch book. There's those 25 tick losses, then the one big winner for 25 ticks, and then 25 ticks of losses, and then one big winner for 25 ticks. And you end up with this kind of weird looking retail portfolio profit and loss account, and it looks a little bit like this. What happens is you get a good winner and you think you're absolutely the God's gift to trading, and then what happens is you get this paper cut situation. You maybe get another loser there and then a scratch and then another loser coming back in again, and then you get a winner and you go, okay, I'm doing okay, and then you get a loser, a little winner, a loser, a scratch trade, a loser, another scratch trade, and a loser, and then you're starting to get a little bit panicked, and you get this next big winner, and then you get another loser, and then a scratch, and then a loser, and a scratch. And obviously what's happening over time is that your account is getting whittled away in terms of your profit and loss. So this is something you've got to be very, very aware of, is how does your account look? Are you getting chipped away at? Are you taking the wrong trades? What are the wrong trades for you? Are you a really bad fader of a market? Or are you really bad at momentum trading? Because you've got to be looking at the things you're really bad at and saying, okay, how can I improve on those? And most of the situations that you can improve on is your order flow trading, your reading of the tape, the old-fashioned art that's long since passed into folklore. Because reading the tape, obviously, in the olden days, that used to be what it was. It used to be a tape, and you used to read it, and that's why it was called reading the tape. And these tapes were set up to give you information, and there was a very, very limited amount of information. It was what the trade was, how many lots were getting dealt, and that's what was going through the tape. What's the current price? How much liquidity is available? These are all tape reading elements to your trading, and obviously when you start using these elements, hopefully your profit and loss changes from this. And what should happen with your profit and loss, guys, looks like this. This is what an institutional scalper's profit and loss looks like. This is what it looks like. Something along that kind of line. It's the exact opposite. There's the occasional winners, there's the occasional scratch trades, there's the occasional losers, there's the occasional big winner, there's a few scratch trades again, there's an occasional loser, and then there's the occasional big winner. And the key thing here is obviously when they do win, they win big, and when they lose small. And that process of scalping, it should be the whole point about your trading. You're never relying on these big winners. So obviously if we didn't have this big winner, for example, and instead we had a scratch trade here, then obviously the next few trades would have been scratch, 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 small loser, and then a good winner. And all of a sudden you're still on that upward moving channel. It's better than what you've had before. And this is something that you're slowly going to pick up on when you start realizing that order flow trading, especially obviously if you're trading in the futures markets, is actually not that difficult in terms of once you understand the concepts of absorptions, exhaustions, all the very simple concepts, you'll suddenly see very, very easy trade opportunities all over your screens. And as I said, you don't need to be using an order flow software to see it. You can obviously use a liquidity type software like a Bookmap or Jigsaw. Very, very, very good tools, obviously. But obviously you've also got the order flow tools through OFA or NOFT or Market Delta or indeed Sierra Charts, our very own suite that David developed for us. Now obviously a lot of you aren't going to have order flow tools, but I strongly recommend that you get them in due course. Once you can obviously afford to get them, then I strongly recommend you do get them, because you can obviously take your stops into very, very tight locations. You can trade properly in these tight locations, and you can put stops behind some of these ideas, and some of these ideas we'll be talking about are things like block trades, for example. So what are we going to be doing in this first few days of order flow? The first few days of order flow, we're just going to be looking at the auction process. We're going to be looking at absorptions. The first thing we're going to look at is absorptions and liquidity hunting. Now, because absorptions and liquidity hunting are very, very similar type beasts. They have the same process. And if you were watching oil today, for example, you would have been able to buy oil at the very, very bottom edge, and you'd have been able to trade oil back up for over $1,000 per contract just this afternoon by doing one thing and one thing only. One thing and one thing only, and that is chasing liquidity. That's all you had to do, and you'd have made over $1,000 today. It's the easiest trade in the world to spot, and it's the trade that the guys that sell order flow tools don't know about. Unbelievable, isn't it? Unbelievable. And we're going to explain what that is, and obviously we'll show you how it played out today. But I want to just touch on the first thing. A little bit of ego stroking never goes wrong. I did tweet this. We drew this box in for anybody this afternoon. I'm curious, who got it? Who got it? We said that we are going to start selling lots and lots and lots of any business at 55, did we not? Anybody remember that conversation this afternoon? I said if we get this box at 55, I am going to sell everything that everybody's got for me. Any buyers that come in here, I am going to be selling them. Does anybody remember that conversation? Okay, Ian remembers it. So, not bad. 1 out of 145 remember. So that's a good start. That's a good start. What happened to that trade, guys? What do you think happened to that trade? Come on, Sam. You must have been on it, because you're normally front-running me, so I would hope you're on it. What happened to this trade? Well, what happened to this trade was the price did go into 67.55. You can see the trade actually did hit this box, and obviously if you're paying attention, You don't need to do disclaimers and all that shit, do you? No? Kim?
Oh, no, we're way past that.
Yeah, I thought so. Okay. Order flow that you can see. Try and spot my order, for example. Try and spot what? What in any of this is difficult, guys? Seriously, what in any of this chart? Beautiful. This is what happened next. The price instantly bounced off $65.80 on down like it's an brains out and light. Part of the process. I'll show you how it played out today. Was it so? Not bad, 1 out of 145, remember, so that's a good start. That's a good start. What happened to that trade, guys? What do you think happened to that trade? Come on, Sam! You must have been on it, because you're normally front-running me, so I would hope you're on it. What happened to this trade? Well, what happened to this trade was the price did go into 67.55. You can see the trade actually did hit this box. And obviously, if you're paying attention to the process, you'd also been aware that we were seeing this continuation of this devaluation kicking into the marketplace here. And obviously, what happened very, very simply is that what happened next was pretty awesome. This is what happened next. This is what happened next. It went from $67.55 down to $65.80. It was only, you know, at the end of the day, it was only $1,700 per contract. But guys, here's the point. That trade was called live in the room this morning. That trade was called live in the room this morning. Agreed? We called it before it happened, guys. We told you what we were going to do if we got that price. And this is what happened next. So, what happened at the bottom edge, guys? What do you think happened at the bottom edge? Can anybody hear a song going off at the bottom edge? Can anybody hear a song going off at the bottom edge, guys? What do you 3 times? There it is, look. There's once, twice, 3 times a doofus. And, you know, it's that famous Lionel Richie song, 3 times a doofus. And there it is. There it is. It's right off the chart, isn't it? With the value going bid at that stage, a lot of people don't realize this is part of the process. And it's obviously not quite what we're talking about tonight, which is going to be specific to order flow, but it's very, very important you get the process, this idea in your head, because order flow is going to be as much use as a chocolate ashtray if you don't figure out the process, if you don't understand how the markets structure, how the markets work. We are short massively. Well, as massive as we could get, because we were taking any buyer that we could get into that top edge. Any buyer above 50, we were giving them whatever they would want. I mean, we gave them, and we took as much business as we could take onto the books at 50 here. Still wasn't a very big amount, but it was good enough to make a large dent in this week's commission check. Anyway, as the price breaks, we're going to distribute some money in here. We're taking some profits here, and obviously we're going to have an initial target price. And obviously the initial target price is what we would call, very simply, the measure. And this is our measure just here. That's where we're going to be looking to take some more profits. Regardless of whether the price action is telling us to or not, this is where we're going to book some profits right here. And obviously as the price extends below that level, we're going to be actively closing the rest of our trade off. I'm now coming out of the trade. I'm distributing to the point that eventually our distribution, which is all buying, stops the market moving down. And we get this first response, and that first response is what is called a short covering rally, because we're covering all our shorts here, we're getting a rally in price, and now value is starting to move to the upside. Now, the one thing you'll be aware of is that we did a classroom last night in terms of a webinar. And what we showed people was this process of how to recognize value, how to recognize accumulations and distributions. And obviously, people that didn't join the class wouldn't have a clue what we were talking about because they still don't know what value really is. But what obviously happens is that as the price moves down through a series of levels, and value moves down in line with that, then this is what happens. The price moves down, we're obviously short, we distribute into this area here, and when we get into this area here, we start to distribute. That's our end distribution. And following that distribution, what now has to happen is we now obviously need to get off the short trade, but we haven't got any net longs. We've got to now take the price into this kind of formation here to accumulate. Now you're in an accumulation period. Because you're accumulating something, remember that. You can't accumulate unless you're accumulating something. Have you ever tried to accumulate nothing? Well, it's difficult, guys. I mean, it's a difficult process trying to accumulate nothing. So when you're trading, you've got to accumulate something, and that something is value. You're accumulating a very, very large amount of value. So when you start seeing this process, you start to understand that this is going to be the opportunity. Now, as I said in the presentation, there's an old-timer saying that you know, at the bottom edge, the old-timer will come in, the old grain guys will come in and say, I bought the break. I bought the break, or I bought the fade. And they did it here. They did it on this one. I bought the break. Oopsies. And this, as I said, was an old-timers thing that anybody that was involved in the grain pits, this is always the thing that they would always tell you about if you ever knew any actual grain traders back in the day, back in the 80s. I bought the break. And then when it comes back in again, they say the second time, I bought the break. And then when it comes into the third time, then obviously what generally happens is they sell the break. Okay? I sold the break. I was the break. Okay? In other words, stops were sprung. Okay? Stops were sprung, they puked their position, and that's how the old-timers came into the marketplace. Now, if this is an old-timer saying, when we stepped into the marketplace, and when I talk about we, I'm talking about the guys that were kind of off-floor, the guys that were the kind of brains behind some of the algorithms, so, you know, the guys that were more analytical. When we stepped into the floor and we started to talk, the first thing I did was I talked to as many floor traders as I could possibly find. I wanted to know. I visited the floor. I played on the floor a few years, and I gained the knowledge of how floor trading works and what the guys are trying to see and what the guys are trying to do. And obviously when you start hearing this type of saying, you start thinking to yourself, I'm going to start designing some algorithms around this. So if we know that if we keep selling and capping these top edges, if we know we can start selling and capping these top edges, this guy eventually will get rid of his big position. And that's when we want to strike into this bottom edge here. That's when we want to strike, during the guy's puking phase, during the guy's stop run phase. That's when we want to strike into it. And obviously what that means in terms of trade is that as a bank versus the floor traders, as a bank, this is our trade here, this is our trade here, and this is our trade here, as a bank trader against the floor traders. So this is the locals' way that they deal. This is how a local will deal here. This is where a local will deal here. The bank will come in, the local will get busted. And then obviously what happens next is because of the weight of money that we put behind the move, we start then buying into this. All of this selling that used to stop the market from going higher, that everybody was leaning against for their short trades, that selling is no longer there because we're not capping the top edge. And obviously what happens next is that when that liquidity disappears, and what we start doing is we start putting some liquidity in here, we then put some liquidity in here, we then put some liquidity in here, we then put some liquidity in here. Well, it's pretty obvious what's going to happen next. Price, 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 price. And this price chases all the way through that liquidity. So it's very, very important as part of your order flow, and it doesn't sound like it's an order flow process, but it is all part of order flow. It's not going to be something you're going to be looking on a footprint and seeing, although there are some signs of that taking place, a little sign called an absorption. Because obviously every time we have one of these upticks, there's always going to be some distribution. As we break through a level, we're going to do some distribution. As we break through maybe another level on another key price, there's going to be a distribution. And as we break through another level, there's going to be a distribution. It doesn't just go from a buy trade into an exit. There are many buy trades, perhaps as many as 20 or 30 individual trades of varying sizes off a bottom edge, and then there's another trade as it breaks, there's another trade as it pullbacks, another trade as it breaks, another trade as it pullbacks. And obviously that process of building a buy-side program, chasing liquidity higher and chasing liquidity higher and keeping chasing liquidity higher, is the process you've got to try and get clear in your own head. And obviously this distribution and then reallocation in terms of reaccumulation, you're normally getting these little pullback type trades, and obviously the price kicks on, and then we get up to another level and a little pullback trade and the price kicks on, and another pullback trade and the price kicks on. And into these pullback trades, every one of these will probably have some sell limit orders, just because these are target prices. But some of them are these old timers. Some of these guys, it's the old floor traders coming into the market thinking the prices went overbaked at the top edge, and then obviously trying to get themselves off the trade. They'll sell it the first time, they'll sell it the second time, and obviously the price breaking the third time breaks them, because they don't want to be consistently on the wrong side. So there's the once, there's the twice, and obviously what we've now got on this chart is that process of there's the doofus trade, there's the old timers coming into the marketplace here and puking their positions. Forgive that expression, it's not the nicest, but it is what it is. And obviously what we're doing is we're initially obviously going to be selling this uptick off of these faders here, capping the top edge as much as we need to. We don't want to do it, but we need to do it if we want to try and get that lower liquidity. And obviously as the price starts downticking, we start accumulating. So it only takes us maybe one bar to stop the market going up, and every subsequent bar that comes in, because we're showing liquidity above the market, of course. And that liquidity allows people to front run us. Well, we want people to front run us, because the less shorts that I take on the books, the more longs I can end up with at the bottom edge. The more sellers that we can encourage into the market at this position here, the better for us in terms of this bottom edge price. So this becomes the bank's long trade here against that guy that's doing, and you can see exactly the same process here. It was on the second move to the upside, but we told you about that trade in advance, and obviously what happened next is quite simply beautiful. This is what happened next. The price instantly bounced off $65.80 on the third strike, and obviously it traded through $67.30. It's another $1,500 on the bounce. So let's just get that straight. $1,700 on the way down on a single contract, $1,500 on the way back up. $3,200 on two trades, guys. Two trades, one single contract. And all you had to do was remember what the song was, remember what we said in the classroom. That's two things you had to remember. What we said in the classroom was I was selling 55 at